He's right that the stock market should reflect the fundamentals that we see on the ground. And when we quantify the fundamentals that we see, we have a 40% GDP forecast, 40% down for Q2. So the way I think about what the markets are pricing in is they do look at these consensus GDP numbers. And that's why I think it's already in the price. It's actually not a surprise to anybody that this is going to be a bad quarter. And it's going to be a slow slog to come back to some sort of level of economic activity. So I think that's actually what's being reflected in the markets. If you think about it another way, if you think about it from the perspective of where we are today with respect to earnings, with respect to multiples, we look at earnings for the next 12 months to be 160. And you apply 17 and a half times multiple to that, you are roughly around these levels of where the market is right now. So the one thing I would say that immediately I am concerned about is this earnings season as it gets underway and more companies do not deliver and it results in actual misses rather than beats. I think that's where the downside for the markets near term is setting up.
So, Josh, it's almost as if we have a couple of disconnects going on. OK, it's the one that Chamath spoke about, how what's happening on Wall Street vis-a-vis the stock market doesn't nearly reflect what's happening on Main Street. But then if you go inside the market, you have a bit of a disconnect as well that I want you to opine on, too, in that and we've discussed this as well, the 5 biggest stocks in the S&P 500, Microsoft, Apple, Amazon, Alphabet, and Facebook, have a weighting equal to the bottom 350. I mean, that's where the money's going. That's from your buddy Michael Batnick, and you guys had been discussing that on Twitter. How concerning is that? I mean, that is a disconnect in and of itself. It speaks to a very, very top-heavy comeback.
This is one of the most difficult. This is one of the most difficult concepts for investors and people who casually watch the market to wrap their heads around, which is the stock market is not the economy, and the S&P is not even the stock market. So the companies that should be getting destroyed right now on the market are. Take a look. Year to date, Gap down 59%, Nordstrom down 60%, Macy's down 71%. They should be. That's the condition of their business. It's not outrageous. But the thing is, those stocks don't matter. They don't move the chains. They're not big enough. Let's take a look at the contributors to the gains we've seen in the S&P this month, and I think this will become more clear to people. The information technology sector is 25% of the SPDR, the SPY index ETF. It's contributed 23% of the total return of the stock market over the last month. Healthcare even more pronounced. It's 16% of market cap, but it's contributed 27% of the return of the S&P over the last month. So that's 2 sectors, the 2 highest weighted sectors by market cap, contributing more than half of the performance of the S&P. So people look at the last month, they say, oh, it's a V, it doesn't make sense. Well, unfortunately, stocks like Hertz, which now trades like a penny stock, it could quadruple and it wouldn't affect what the S&P does. So we have got to stop conflating the condition of the economy with the S&P on a daily, weekly, or even monthly basis. It's almost always going to look bizarre. And right now,
get your point.
Chamath is right.
Your point's well taken. But what happens if you get any sort of weakness or pullback in the stocks that you just mentioned that have been towing the car along? That would be a problem at large for the market, right? I mean, if you have these higher weighted sectors that are pulling all the weight, the slightest blip in that is a potential problem for this move.
Only if another group doesn't rise up to take their place. And one of the stories of the last 10 years has been a continuing rotation, mostly technology in the lead, but we've had periods where technology has faltered and other sectors have risen up to take the mantle, and that's a rotation beneath record highs. Look at biotech on the week. It's up 10%. On the week, these aren't $20 million microcap stocks. I'm talking about $100 billion companies. They're up 10% in a week. So even if you didn't have great performance this week out of, hypothetically, let's say Apple, the slack has gotten picked up by other areas with secular growth. So That's not an all-clear signal. That's not a signal to ignore the fact that this morning we saw 4.5 million more people laid off. I'm just talking about the fact that the way the stock market operates on a daily basis is not going to give you a linear comfort with whatever your macroeconomic view is. The market is designed to frustrate the maximum amount of people, and that's what it's doing right now.